Hello and welcome. My name is Llew Jury. I'm the founder and executive chairman of Sprint Ventures, and I'm delighted to be here today to present at the Capital HQ Masterclass Conference about crafting a robust family office or fund investment thesis. I'll just get straight into my presentation, and before I do, I just want to go through our disclaimer under our AFSL. This is general advice only today, and I encourage you to read this disclaimer at your leisure. Today, I want to talk about how we've crafted our own VC fund investment thesis. It's very similar to setting up a family office investment thesis, especially for those family offices that are setting up a VC arm or a private equity alternatives stream to their office. I just wanted to take you through how we've done it over the last 4.5 years. The Sprint partners have been a key part of that, and they're led by the managing partner, Georgia Barkell, myself as one of the founders alongside Heath and Ben, and together we have nearly 100 years of experience across financial services, startups, entrepreneurship, accelerators, the corporate world, and we think that that's a really good place to build a fund with all those different levels of experience. Enough about us, though. Today, really what I want to do is dive into the 7 steps that when we put this together, we thought were the most important 7 steps when setting up a family office or a fund investment thesis. When you set up the family office and fund investment thesis, they normally go hand in hand. Normally when you set up a fund, a venture fund, a private equity fund, it's very similar. You need to go back to the building blocks and the structural elements of setting up that fund to get it right. Often with family offices, it's about the generational piece, and we see that all the time. We've got 75 investors in our 2 funds, and we'll be raising a 3rd fund next year, and we'll be adopting a lot of what we are talking about today in terms of the setting up of the actual funds and also the establishment of the investment thesis and how we go then about deploying capital to ultimately provide that alpha. So it requires careful planning and collaboration. Collaboration is probably the most important word here out of this whole slide, because the collaboration leads to great integration of different perspectives within the family office or the fund that you're setting up. Basically, you need to use all the different views. I think often the younger generation, if you want to call it that, of a family office or the young guns within a fund, especially a VC fund, might often overlook some of that experience that can come from the different generations that have actually often been the ones that have really driven the core growth elements to being where a family office is and setting that up. It does take time, so there's a note there to really plan things out, take time, and really treat this as patient capital, because to get and generate those long-term alpha and successful investments, you do need a lot of patience, you do need a lot of resilience, and you need a bit of time to support your investment thesis. With everything, it's important to remember that past performance is not an indicator of future performance. So go in with your eyes wide open. Like anything we do when we look at funds, we treat them as a brand new fund when we're setting them up. And although we might have had success in our former businesses, in our commercial life, in our previous funds, in the portfolio companies, you still need to go in with your eyes wide open. The first step that we recommend when you set up a fund or a family office investment thesis is define the objective. Go back to the core elements of why you're doing this. And most importantly, we believe, and what we've done at Sprint, is set up the governance structures. There's a few questions to ask when you set up a family office investment thesis. The most important thing is who will run the money, who will be on the investment committee and who will be the chair of that investment committee. What sort of board structures do you need, and who would ultimately chair the board? Do you bring in an independent external chairperson to actually help provide a level of independence within your governance frameworks? And what governance, risk, and compliance needs do you have that are really going to allow you to appropriately set up, monitor, report, and evaluate your asset allocation? Is that a third-party governance, risk, and compliance committee like we have at Sprint? That is chaired by an independent, extremely qualified independent chairperson that really allows that separation of governance and powers within the organisation. It's important to note when you are defining the objectives and the governance structure of a family office, make sure that the founding generation is involved in all the discussions. Your family values, are integrated because they're essential within how you actually are going to construct your go-to-market, your investment thesis, your mandate, the reporting, etc. And make sure those insights are adopted and they guide the vision for the future generations coming through your family office. There's no difference of actually how you build a fund, especially a venture capital fund like with Sprint. What we see is making sure that there's open collaboration and a robust level of insight sharing that keeps going. It starts at the beginning at step one here, but it actually goes and permeates through the whole organization for the time frame that you're working together, which is often decades. And some artifacts that get produced at this step are a family constitution, a family council with an underpinning charter, and really, really good in terms of having those assets and those artifacts that are generated that maybe are signed off with each of the different parties within your organization. I just want to stop and pause and thank Rawlings Bolton, who are actually providing some of this content. And there's a leave behind at the end of this presentation that you'll be able to access and take home. On to step two. So what you need to do once you've set up that governance framework and defined the objectives, you need to assess the financial resources and requirements. At this stage, it's important to engage some experienced financial and legal advisors who can help optimize your family resources. They can help optimize your fund as well. We did the same. We got in at this stage some really experienced legal fund experts to set up and craft the right components of that. And in a venture fund and even family offices, you can look at things like ESVCLP, early stage venture capital, limited partnerships, which need to be registered. They need to be considered. They take months, if not up to a year, to actually get approved. But they do provide benefit to either the family office or the fund if you can be successful in securing things like ESVCLP. But make sure you basically start partnering with these key people, and they're going to basically try and break down this very complex world of funds management, mandate, investment committees, and they're going to basically look at the holistic helicopter view of where you've been, where you've come from, and really simplify early on what your investment mandate will be based on the accumulated family wealth. And that's not just financial capital, that's the experiential capital, the network capital, the social capital that a family office brings from all the different generations and different components of a family office. And the outcomes, as I said, were engage the advisors at this crucial second stage. And often they are the lawyers and the accountants that understand the tax implication. So there's another stage that I recommend is defining the cornerstone investment objectives. So what this statement and this thesis defines is that what do you want to do and what do you want to achieve from this particular family office or fund that you're setting up? When you build the investment thesis and the mandate around the family office and the fund, basically, are you looking for long-term wealth preservation? Are you looking for capital growth? Are you looking for income generation? or are you looking for a combination of those objectives? And the family offices that we see that are successful with this actually employ at this stage someone that can come in as a chief investment officer. They're a trusted advisor often, and then they get appointed into that CIO role. And they basically can help construct and craft where the family wants to go. And it's a bit like setting up a fund. When you set up a venture capital fund, you've got an investment thesis, you want to deploy capital into certain areas of early stage often, and that's pre-seed, seed, Series A, Series B, etc. But you might not want to do Series B. So you might actually want to focus more on pre-seed and seed. And so you need to actually define your core objectives at this stage. But back onto the family office, what you're looking at here is wealth preservation and different areas that can provide this. Now, again, this is general advice only, and I do recommend talking to professionals that can actually do the construction of this at a more detailed level. If not, appoint your own person that has those financial qualifications and advisory qualifications to allow you to, I suppose, get a great understanding of where you're going to do your asset allocation. As I said before, establish those legal and tax structures on the back of that work. Make sure you set up the best tax structures, of course. One size does not fit all, and the advisors will be able to help you out. An important consideration at this stage is, do you actually set up an AFSL, an Australian Financial Services License? Do you become a corporate authorised representative of an AFSL? As an example, Sprint, we're an authorised representative of Boutique Capital, and Boutique are the AFSL. We're under the auspices and reporting requirements of that AFSL. So whatever they have to do to ASIC, we have to do as well. And that's prudent, good behaviour, good muscle memory from the start, is to actually set up and clearly identify what your objectives are going to be and whether you actually are going to require that authorised representative. And who do you go to? Who do you trust? How much is it importantly going to cost? And do you have the people within your organisation that can actually handle all of the compliance and reporting requirements that you need, as well as, importantly, the risk requirements that you're going to have? Step 4 is build a team and define roles. This is a really important part of setting up a fund, a VC fund, setting up a family office. There's no distinction here. As we all know, people are the most important thing within any organization. And finding the best professionals who align with your family goals or your fund goals will take time to put together. This is the part where helping the founding generation of a family office understand that you might need some differences of style, let's say. So as you see today, I'm wearing a t-shirt. So we've got t-shirts versus suits. Often some people within family offices wear more suits. You might need some younger people with younger investment ideas and ideologies and visions coming through to create a real robust breadth of discussion and adding a different dimension to your investment thesis. It's important to involve everybody within the family office or the fund about who's the next hire, why you've got the next hire. What we do at Sprint is actually on the whiteboard put up our organisational charts. We spend a lot of time about getting an understanding of who we need. And that's not just who we need from an investment decision point of view. It's actually more behavioural science around the right person, the right fit in terms of the next role that we're hiring. So really important that you look at the behaviours of people and also their skills, of course, and involve the family, involve everybody within that decision. At this stage, as that third point states, it's important to have members of your team that have investment committee experience, they have investing experience, they might have portfolio management experience, and they're not, you can have people that come from maybe a generic background, but you really need some people with some muscle memory within the space that you're going after. For example, some of the family offices that I've seen over the years that have been very successful here have recruited people that have bring different perspectives, different worldly perspectives, different investment thesis perspectives. That might be social capital in terms of impact investing. And what they bring is very unique and very different, but it complements all of the other asset allocation that's going on with that family office. So that person might be the social impact venture style PE alternatives investor, and others within the family office are off with the bonds and the property and all those other and the cash, all those other different types of investments. So a little pitfall that we've seen is when a family office tries to add a venture capital investor too early and doesn't consider portfolio construction. And by that, what we mean is the construction within the alternative sleeve of your asset, and whether there's alignment there to have early stage, often younger founders out of accelerators coming into the family office and being on the portfolio of a family office, either fund or within their remit. And sometimes there's a bit of a misalignment, both from the person trying to achieve venture and high risk investments at that early stage with the generational piece back in the family office. I think in venture capital and having in venture capital funds, the investment thesis is driven to that. And if you're building a family office and you're building venture capital within your family office, it's important to note that just by employing a person, potentially straight out of uni or a couple of years under their belt, and just plonking them into your family office and hoping that they're going to deliver the alpha returns on early stage venture type investments might not work out in the timeframes that you're expecting. Step 5, develop investment and wealth management strategies. So yeah, this is what I was saying before about asset allocation. And what I've got here is an internal asset allocation self-assessment map that we use at Sprint. And this is, again, general advice only, because there is different pieces of different assets that can be added and moved around in here. This is our take, our interpretation for our investors that come on board as LPs when we actually talk about the venture capital space. So again, general advice only. But down in the bottom, on the axis, you've got the return. The higher the return, the higher the risk, potential risk level. And down in the bottom left there, you've got the fixed interest, you've got the cash, the bonds, the corporate bonds, etc. And the next sort of side of the next scale of risk is property, resi property, a bit of commercial property. Things go up and down, things move out here, of course, and it's always in the news. And then up into sort of the more high risk, having your own business, being in private equity, having small cap equities. Blue chips sometimes can come down, but sometimes depending on the macro forces and the markets, equities can be slightly exposed, right up to venture capital hedge funds, which are up in the alternatives, higher risk, but potentially higher return asset classes. And it's important for a family office, to make sure they understand their attachment to their existing business investments or their property investments or their bonds or whatever they've been doing. It may hinder their appreciation for the diversification of the different asset classes that are needed. And especially when we see it from the flip side, we're explaining that venture is high risk. So if you're constructing an investment thesis within a family office and you are considering private equity or venture capital as an option, it's important to carve out a sleeve of that, like you would do with each of those different areas or those different assets. And make sure that, again, you talk to your chief investment officer that you've recently appointed, or the asset allocators, the financial advisors that you might bring through to actually get a robust, risk tolerance built to your specific investment philosophies. And all of this is best formalized through an investment policy, a document that everybody can sign off on within the organization. Here's a bit of a capital deals pipeline and investment policy that's taken into an actual image format for you. So this is venture capital. We're up in the high risk, potentially high return. We're looking at 7 to 10, 12 years to potentially get that alpha from a portfolio of companies. And how do you actually find those portfolio of companies? And so the investment document, investment policies that come out of this stage need to be reflective of where you'll be. So if you're crafting up a family office and you're looking to build that investment mandate, and part of that is alternatives, and part of that alternatives is private equity with venture capital, you do need to have people that are present within all those different areas at the top of the funnel. You need people attending incubators and accelerators. You need them partnering with universities. You need to understand who the advisors are, who will give you that deal flow, because it's about bringing that 100 or so opportunities per month through the funnel. Because as we know, and as we invest at Sprint, it's 1 in 100 that actually get through. So really important to understand the landscape of your deal flow network, the opportunities network, and whether you've got the right people within your investment policy plugged into these extensive national networks of accelerators and other venture funds. The other piece to this is how you actually then build up your investment philosophy and how you then go and market that philosophy. And this is taken directly from our IM and DEX. When we go out to talk to potential LPs, often family offices, high net worth individuals, institutional investors, they do want to know how you're different and how you're achieving the long-term opportunity for alpha. So what we do is we look at core values, and then we pull out one of those core values, the core value, which is actually founders first, which goes into everything we do. It's pretty much in the DNA. We back in the truly great founders to provide the ultimate alpha through their hard work, but we support them with social infrastructure, experiential network, and human capital to help supplement them and help them globally scale and build that. So you can see there's 4 core areas on the left. Place founders first, right at the top. We become their trusted advisors. We always have value realization in mind, so the exit in mind. So you need not just the buy side, you need the grow or the hold side, and then the sell side, which is the exit. And then we need, you need to understand how we fit in from an ESG point of view in the community, the ecosystem within what we do. On the right-hand side there, we've pulled out then one of those things, which is the most important to us, is if you can find a great founder, often that great founder will provide that success, even if they have to pivot within the business at the early stages of venture. So if a family office, for example, is getting into this area, they need to go and meet those truly great founders. They need to be amongst those great founders. And the family offices that we know from our venture community that we catch up with a lot, are very active within those areas alongside us. A really important part of the modern family office investment thesis in crafting and building a family office or a fund is to actually have efficient administration and operational back office systems. These things are crucial, not only for productivity and efficiency gains, but actually for day-to-day operations and saving costs within the actual family office and the business. These systems require ongoing attention. They need support. They often are software that you can't just set and forget. Often you need to explain this to the founding generation, that the value of technology solutions or compliance frameworks is vital to the back office success within the family office, and therefore the successful running of an investment thesis and investment mandate. What I suggest is look at APIs. So these are things that can help plug into different bits of kit. And at Sprint, we've actually built our whole system, our whole Sprint back office. That includes artificial intelligence now, using APIs, using things like Airtable, Slack, Google Forms, Zapier for the APIs, and then some OpenAI to actually help run some artificial intelligence across all of the deal flow that comes in. And these are cost-effective platforms. You can always move to things like Salesforce, Affinity, and others later on. But there is great software out there that you can actually use, which really will speed up a lot of your transaction time and a lot of the due diligence time that you're going to need, rather than running it on Microsoft Word and Microsoft Excel. So an important stage, and probably the final step to talk about today, is the family education and communication programs, where we see funds break down in their investment thesis, or a family office struggling with an investment thesis, especially within our sleeve of alternatives in private equity and venture capital, is always having communication programs. This is, based on the annual events that a family office might put on. We say that every quarter there should be initiatives that are delivered, such as family forums, monthly lunch and learns that might be quarterly, but we do them monthly at Sprint. And it's an ongoing evolution of education and training. It's not just set it up, it's all going to happen, and the investment thesis is going to run itself. Things change within an investment thesis, and things need to be malleable and being able to pivot. Of course, under the auspices of an ESPCLP and a limited partnership agreement, you cannot change a lot of that, and especially like a trust. It's very difficult to change some of those structural things, so get them right back in stage 2 and stage 3. But it's important if you need to bend and flex. And I'll give you an example, as your minimum investment amount might change in terms of how things are going from 6 months. In 6 months' time, things might be different, and so you might need to reduce or raise your minimum thresholds for your investment checks because of macro forces, because of market forces, and sometimes you need to have that flexibility. You need to communicate that, and it's often important that founding generations are bought in, because they've probably gone through a number of these cycles, and those founding generations can provide some pearls of wisdom at this stage when you're you're really sort of working through investments, portfolio management, and trying to realize returns. So that's the end of the presentation today. I just wanted to thank Rawlings Bolton for providing a great takeaway from this session. It's about setting up an investment policy statement, which covers a lot of what I talked today. And you can go to rbco.au/IPS and register your details there. They'll automatically send you a PDF document, which gives you a number of the different themes that I talked about. And that's a really great document that they've prepared in terms of when you set up and craft a family office, especially the investment thesis and some of the things, the peripheral things that you need to know when you do that. My contact details are there on the left. My name's Llew Jury. I'm the founder executive chairman of Sprint, and it's been an absolute pleasure talking to you today for Wholesale Investors Capital HQ Masterclass.